All right, let's get back to banking in Nigeria. On Friday, we had that annual general meeting held by Access Holdings, capital raising plans of up to $1.5 billion, a rights issue of 365 billion naira. They also ratified the non-executive director appointments, including shareholders praising Mr. Aiko Mokode coming back as the chair of the company. So Deloitte, of course, put out a report on the banking sector, particularly in Nigeria, the recapitalization exercise with the new thresholds from the Central Bank of Nigeria. We had a full-blown conversation with Abimbola Ogundare. She's a partner, Africa Corporate Finance Leader, ex-SA at Deloitte. Here it is.
Just stepping back and seeing where, that drive is coming from. A lot of it, or all of it, I would say, has to come from the recent announcement by the CBN. Banks have to take a step to recapitalize. And so we're coming from a base of 25 billion for all the banks today. The CBN has stated that they have 2 years until the 31st of March 2026 to scale up significantly, depending on what sort of license you have. So for those with a regional license, they have to scale up just 2 times to 50 billion capital requirement. For those with a national license, it's a times 8 scale up to 200 billion. And for those with an international license, it's a times 20 scale up to 500 billion. And so just looking at where Access Bank sits in the league of banks, they are a tier 1 bank. And as we've seen with a number of tier 1 banks in the market, there have been a number of announcements around, coming to the market, raising additional capital. And it just, sits within the options that the CBN had given. So 1, raise fresh capital. Go to the market, whether that's by way of a listing by introduction, an IPO, or private placement, or an M&A option, which is option 2. And the last option is, take a look at your license, decide if you want to upgrade or downgrade your license. So, the move by Access Bank is really a strategic move in terms of, as an international bank, we know that, it's within the Access Corporation structure. It really has to be, how do I move forward with this immediate ask? But even beyond that, how do I fuel my international expansion drive and continue to provide value to my shareholders?
Fantastic. There's your report looked at, I guess, the impact from a financial perspective on each of those options. I think you're looking at whether it's dilutive to shareholders, whether there's any growth prospect from it, and then timeliness and I guess cost of implementation. For each of those, I guess it's one or the other, yes, as far as those options.
Yes, you are correct. In deciding what path to take, there will be considerations around how long is this going to take me? How complex is this? What does this mean for my current shareholders? Is it going to be a dilutive effect? Will I retain the same complement of owners and decision makers, or do I have to let additional people in as owners that make up my share capital and my share premium? And if you take the options one by one, so the first option is, go out and raise additional capital. If it's a rights issue, that means that you approach existing shareholders and ask them to top up their investment to the tune of the additional money that you need. Rights issues historically, have not always been taken up pari passu with the level of initial shareholding. And so you might still have some dilutive effects, but it's much better than what would happen if it's an IPO or an other public means of raising capital. So from a dilutive effect standpoint, raising fresh capital, if you're worried about your shareholder bar, perhaps the rights issue is the way to go. Now, in terms of what growth prospects, growth prospects would really be if you go out and raise additional capital. The equity story has to be strong. So, as a bank today, you have a certain bar that is, expected returns. If you have more money in your coffers and you have to produce more assets and more value from that, the expectation is that the returns profile does not drop. And so the growth prospects as you raise additional capital, whatever option you pick, has to be strong. The value offering has to be strong to shareholders so that they give you that money to go out, meet your capital, and continue to deliver returns to them. And from a process standpoint and a timeline to completion, one of the more straightforward or apparently straightforward options may be to decide, I'm a national bank today, but perhaps I want to focus on a more regional play. And so I'm going to downgrade my license. That may seem like, an easy decision, but there's so much more that you have to think about from a process standpoint. It may be that you then have to decide how many branches you're rationalizing because you're no longer, a national player. But it also has implications for the people that are in your employ. And you also have to take care of, make sure from a tax standpoint, the respective, State Board of Internal Revenues have to be settled, closed. So, when you look at the different options, the M&A option as well, that's definitely dilutive, unless it's a merger of equals, so to say. So, whatever option you look at as a player in the industry, it has to be that it makes sense to you from the perspective of whether you're letting additional people onto your board and decision-making panel, and you're comfortable with that. From the perspective of how long this is going to take you, because don't forget that in the 2 years, there is business as usual. You do have existing shareholders whom you have to satisfy, right? And so you don't want to take your eyes off the ball and focus for 2 years on a recapitalization while letting the business of the day die. So from a timeline and process standpoint, you have to consider all of these carefully.
Hey, that's excellent breakdown. Thank you so much for that. There was a nice chart on your report where you said you look at how M&A transactions should go from the Deloitte perspective. Can you touch on that, on how you think that should happen?
Absolutely. The start of any M&A conversation is the why. Why are we doing this? The CBN has answered that question for quite a number of banks today. But beyond the recapitalization drive, there is the part where, as a business, you decide how you're going to grow. Organically, inorganically. If you grow inorganically, will it be the M&A route? And what does that mean for you? So that's your why. That's always the starting point. Moving on from there is, if I do decide to go the M&A route, who do I go with? There's a universe of options in the current players. But it really boils down to a size fit, a cultural fit. So there may be a certain way of doing things in an organization and a different way of doing things in another, where if you have an M&A, if you don't think about integration carefully, it may not turn out well. So there is that bit around who to go with, the why, the who to go with, and then how much do I pay for this process? So how much do I pay boils down to a financial due diligence, a tax due diligence, an operational due diligence, an HR due diligence, because you do have to look at the complement of people that you're taking on. And you have to be sure that you have the right advisors through that process, because, starting the conversation and seeing what is on paper of what I'm worth is different from going in there and understanding the real quality of your loan book and what that means for me when we come together as a bigger bank with a higher capital threshold. And then, the last bit I will talk about is integration. So with integration, you want to begin with the end in mind. You want to think, what are the things that can tank this over, even as I start the conversation, and start to build those in your entire due diligence operation. You also have to make timely, quick decisions. So as you decide, this is how we're going ahead, let there be proper communication. So remember now you have a plethora of stakeholders. You have both banks that are in the conversation. You have the regulators. You have potentially SEC, FCCPA, and the other regulatory bodies, and even the depositors. So, one of the questions that has been asked of, the regulator is, how do we make sure that in this whole exercise, the depositors are protected? Because if a certain bank goes down, what happens to depositors' money? So the whole conversation around, why am I doing this? Who am I doing this with? What due diligence considerations must I bring to the fore? And how do I integrate properly such that it's a seamless union is something that has to be thought through for an M&A process.
M&A 101 from Deloitte. Excellent stuff, Abimbola. Okay, I also want to get your thoughts on two other recapitalization options that your report talks about. Subject to CBN approval, retained earnings and debts. I guess there's been a lot of talk about the bank CBN not really allowing that.
Yes.
And, so what are your thoughts there?
You're right, Rotus. It's a front burner issue for a number of players who have said, hey, why not allow us to take the dividends in our books and just move that into the share capital, tier 1 capital that qualifies. The CBN has been quite clear to say that only share capital and share premium will qualify for this exercise. And in doing so, if you take a step back, it really is what is driving this. President Tinubu had come out to say that the $1 trillion economy, the $1 trillion economy that we're looking at by 2030 will need some fuel along the journey. And some of that fuel will come from structural and process adjustments like this recapitalization. In order for that to happen, it needs to be fresh capital that comes in and not a recycling, so to say, of existing capital. Where that capital is cash, fully realized gains, then perhaps there is a conversation to be had. And, a significant part of the retained earnings will be cash backed, but there may be some elements in there of, just, unrealized FX gains, for instance. And so the question comes around, in this climate where we see even some of those FX gains unwinding over the last few weeks, are we taking like for like if we move in that whole complement without just making sure that it's backed by cash? And I think the other one was around debt capital.
Yes.
So for the debt capital conversation, it would be having a think around supporting current operations or raising capital. That would be tier 2 capital, and then using that for the M&A drive. That also each bank will have to think very carefully through that. The CBN will have to approve whatever the plans are. In today's debt climate, it's a high cost of capital if you're going to go that route. And so you also have to make sure that, it makes sense from a returns perspective.
Thank you so much. The report talks about the implications of this increase in capital buffers. It was quite bullish as far as the macroeconomic impacts. You talk about increased liquidity, expansion of economic activity, and bigger transactions. Can you speak towards some of those?
Absolutely. So on the back of the recapitalization, so if we take a step back and say, what is in the system today? The stock of broad money is somewhere around, I think, 95 trillion as of February 2024. A few months before that, at the end of 2023, we were somewhere around 10% below that. Now, if you take the stock of broad money today and say that over the next 2 years, there's going to be an influx of domestic money, foreign money coming in to support the recapitalization drive, it means that the stock of money will increase. Now, what does that mean from a monetary policy perspective? It means we have to think of issues around inflation. So inflation today is hovering around the 30% mark. And quite some concerted efforts are being made to, moderate that. But as more money comes in, you then have to think of demand pull inflation and what impact that has. So, you have to think carefully around monetary policy controls that will keep that in place. As more money comes in, we also expect our capital markets to deepen. So today, our capitalization as a percentage of GDP is somewhere around 19%. When you compare that with, other more advanced African economies, in South Africa, it's somewhere around 300%. So it just shows you the buffer and the scale to which we can improve. But even, around smaller economies, but still more developed, if you look at North Africa, for Morocco, I believe it's about 50%. But India, which is comparable to us, is somewhere around 150%. So with that additional money, And with some of that coming from a capital raise that would necessarily be through the capital markets, we expect that some of that headroom will be closed, and there will be some additional liquidity. And for FDI as well, so as foreign direct investment, foreign portfolio investment increases, we expect that larger transactions will be undertaken, so people will be able to take on larger projects. That should have a cycle through effect to more jobs. We talk about underemployment quite a lot. The capacity scaling that can happen from bigger transactions, bigger projects, and the knock-on effect to the circular economy is something that, we're hopeful that over the next 2 years we continue to see.
All right, we'll see how things work out. You touched on this earlier, but maybe you can just, again, the tax implications and also workforce implications of these exercises, this recapitalization exercise.
So from a tax perspective, just taking a step back, as part of the options that every bank considers, they will look at every possible implication to the extent that it can be captured. And the CBN has asked that, banks come up with a plan by the end of this month, by 30th of April, which is why we see a number of the tier one banks saying, they're going to raise certain amounts between 200 billion to 500 billion for the top tier banks and all of those that have made announcements. Now, whatever option you take, you will think through tax implications. I talked briefly about potential tax implications if you decide to, for instance, downgrade your license, where you then have to rationalize other jurisdictions and engage with the tax authorities to wind down or cease operations over there. But if, for instance, you decided to go the route of raising capital, you'd probably be looking at, at the very minimum, the stamp duties, which would accrue for the incremental capital that you would raise. If you were to go through an M&A option, right, it would be a case of whether you're looking at a share deal or an asset deal. For a share deal, there may be a number of tax implications. For an asset deal, you would have maybe some other considerations around what the tax written down value of the assets that are being moved are, and if there are any additional implications there, But, across the plethora of taxes, from stamp duties to withholding taxes, if, for instance, you were to consider the dividend capitalization route, there will be withholding taxes, even though that amount was moved from dividends to capital. The tax authorities would treat that as though there was a payment of dividends and then a recycling in, and so withholding taxes would apply.
Thank you so much for that. Just to round off, I mean, if we zoom out look at the regions, just the sub-Saharan landscape for investment, looking at East, I guess, and West, how are you seeing things?
I mean, it's interesting. If I take, West, just to start, if you spoke to the typical investor and said, if you look at West Africa, what are the economies that come to mind from an investment standpoint? You'd probably hear a handful talk about Nigeria and Ghana from an Anglophone West Africa perspective, and perhaps Cote d'Ivoire from a Francophone West Africa perspective. I'll speak a little about, Nigeria and what we're seeing in the deal landscape. Strong macroeconomic headwinds, but we're seeing a moderation in that. And that really helps with investment attractiveness. Foreign portfolio investments have increased over the last month just on the back of an improved rate environment. From an equity perspective, a number of sectors continue to see quite some activity. The oil and gas sector, specifically the upstream sector, we've seen a number of global IOCs take a rationalization position on their investments. So we've seen Mobil producing, Shell producing, Equinor take a different position on their Nigeria exposures. And we've also seen local companies step up to take some of those stakes. Seplat and the Renaissance Group, I believe those are public transactions. So in the oil and gas space, there continues to be a lot of activity. Now, the financial services space is also one. historically, or let me say over the last few years, a lot of the activity there has been around the pension players, asset managers, but fintech. Fintech, has really stood out in terms of deal flow, deal activity. And we continue to support, both the unicorns and pre-unicorns in their growth story. Outside of that, consumer markets has been very interesting. So a lot of people say consumer markets is the real economy, is the mainstay, is where, the real tangible value is created. Just based on the macroeconomic headwinds, we've seen a number of players, announce that they're exiting. GSK, P&G last year had just talked about just rethinking their positions, their local positions, and reducing their exposures. But we've also seen players like Nigerian breweries think through how to expand their category representation and make investments in Distil. There was an 80% investment, an equity investment in Distil over the last few months. So from a consumer markets perspective, retail is also one where we're seeing, quite some activity as well, but that will be outside of West. We're seeing quite some activity in East, and I'll talk a little bit about the Eastern markets in a bit. So those are some highlights around what we're seeing in West. Now for the East African market, very strong growth prospects. Between Kenya, Tanzania, Ethiopia, which are maybe the larger economies in East, growth rates of 6 to 7%, which, are pretty strong for the medium term. In terms of investment landscape, quite some activity around banking. So Uganda is a smaller economy, but they're also going through, a recapitalization drive similar to ours. But from the perspective of size, we see quite a lot happening in Kenya, which is the darling of East Africa from an openness perspective, but very strong growth rates from Ethiopia. Ethiopia has historically been a closed economy, but within that economy, significant opportunities. We expect that the exchange body will come up this year. There are talks around that, and potentially there may be conversations around some state-owned enterprises being up for investment. But in Kenya, Pula is, a recent deal, I believe, that talks about how interesting the startup ecosystem there is. Pula is an agri-insurance business that has recently raised Series B money and is able to then expand agri-insurance, its agri-insurance offering across Africa, across Asia and Latin America. And in the power space, we've seen 1 or 2 investments in green energy. PPI has invested $12 billion, I believe, in an ammonia 300 megawatts fertilizer project in Kenya. And phase 1 of that, which is $4 billion, is underway. So quite some activity in both regions and very strong growth prospects. The macroeconomic headwinds continue to be one to watch out for, but you can't deny the growth prospects.